I am super excited today, Samantha, to welcome you into my podcast. My show is all about delivering and producing great content, and this is why I've been trying to get you here for quite some time. So I'm super excited that you finally found the time to be here and really to pour and share all your knowledge, your experience, and all the little nuggets that you could share with our listeners. So let's dive right in.
Yes.
Samantha, what brought you into this field? How did you begin your journey? And I understand it's a family business, and I understand that it's something that your mother started.
Yes.
Which is super exciting for me because not too many children would follow the footprints of their parents. So it shows to me that you have a very good relationship with your mom.
Yes.
And it sounds like she is a good role model for you. So let's begin with where it all started.
Yeah. So our company, we're called Credit Repair Boss. We're located in Uniondale, New York, so Long Island. We do have an office as well on the West Coast, and we can service people just about everywhere. But I started this journey with my mom because soon after college, I realized I actually knew nothing about money. I was very fortunate, very blessed that my parents had created such a stable household for us financially. But once I left school and I was left to do things on my own, I actually did try to start my own business. I made a lot of mistakes. And my mom said, "You have no idea what you're doing. You need to learn about money."
Yes.
And, most kids, when you leave college, you're like, okay, let me just go for the salary job. Let me try to, start earning some income. But I had no idea how to run an actual business. And that was my first, foray into trying to know how to handle my finances on my own. So my mom, she started this business once all of the three kids, I have two brothers, graduated from college, and she just had a passion for empowering people, coaching them, talking about finances, because there's such a fear associated with money, with credit, and there is a lot of unknowns out there. And for a lot of immigrants or products of immigrants like I was, there isn't a good resource or area or way to find out more information about how to build your finances in America or how to start a business in America. So she started this business. She was really doing it on her own, and she was servicing a lot of her friends of friends. It was referral based only. And once I started my other business and made a lot of mistakes, she said, "You're going to learn from me. You're going to learn about all of this because you don't know anything."
Right.
And that's really how I got started. And I didn't know at the beginning that I was going to have such a passion for it. I thought, okay, maybe I just need to learn a little bit and then I'll go off and do my thing again. But I also fell in love with it. I do love working with individuals one-on-one. It's not even just about, fixing somebody's score, but it's about taking people on their journey.
Nice.
Because we've been open for, 10 years now. So
Wow.
we have clients where we've been able to help them in 2014. They ended up, after we fixed their credit, getting their first home, and then teaching them how to open up a business, and then
So
eventually
exciting.
getting them into investment properties. And so our clients are like family now. We've been on this journey with them, and we love working with them and being able to coach them and be along for the ride.
Sounds like so much fun.
Yeah.
And I also believe in get by giving.
Yes.
The more you give, the more you're going to get.
Yeah.
It doesn't have to be always in the materialistic ways.
100%.
Like money is not always in between people. Sometimes you're going to get clients that have no idea where to begin, right?
Yeah.
And sometimes people can't probably even afford to start the process. But you need to baby steps guide them. So let's dive right into credit, because that's your niche, right?
Yes.
This is what you are an expert in. This is why we invited you. And I can't wait for my audience to hear everything that you need to share. So let's dive right in. Let's talk about credit, how important the credit is in this country specifically. Like I came to this country, I was only 17 years old. I had no idea what credit cards are. We didn't have credit cards in my country. And I had no idea what credit is.
Yeah.
So it's all new to a lot of people, and especially to kids graduating high schools and starting colleges. I think, and I wish that there would be a curriculum one day talking about credit, opening up bank accounts,
Yep.
Really teaching kids real life lessons where to begin.
Yeah.
I think it should be credit one-on-one lessons where kids should really take curriculum and classes and understand and enjoy where does it begin? The whole relationship with money.
Yes.
Money is just like everything else. It has energy. You
Yes.
need to have relationship with money.
You do.
And so let's talk about credit. Let's talk about money, and let's talk about all this wonderful journey that you could experience by having the best one.
Okay.
Let's go right in.
Yeah, so credit, it's a system that's been built here in America, and it's one where a bank or financial institution is able to check it, and they'll be able to say, Olga, based on this number score, I believe I can trust you, right? So depending on the score and where you're at, there are different brackets. So you could have a low credit score. If you're, let's say, in a 450 credit score to a 600 credit score, you're considered untrustworthy. Then you can go into 600 to 700. Okay, moderate risk for the bank. And then once you're above, let's say 700 FICO score, the bank say, wow, this person is really trustworthy. It looks like they make their payments on time. I can lend my credit to them and know that I'll be able to get my money back or have a return on that investment. And so the system that they've built, it does get a bit complicated sometimes because people don't realize there are different factors, there are different credit bureaus. So even just to start on the general sense, you have 3 different credit bureaus. So you have Experian, you have Equifax, and you have TransUnion. Now, what these credit bureaus do is they take the information from the bank. Let's say you have a credit card with Chase Bank. Chase Bank will then report your payment history to these 3 credit bureaus. So depending on what you're applying for, that information should be present on the credit report. But again, sometimes people don't realize there are actually 3 different bureaus, and sometimes they don't all report the same information. So it gets complicated because they'll say, I pulled my credit report on Credit Karma. It looks like my score is a 700. Then they go to the mortgage bank, which pulls usually all 3 bureaus. And on Experian, they have 5 medical collections. They just didn't know because they weren't checking that bureau. So there are 3 bureaus that are taking a log of your financial history. And the 3 bureaus we do have to check and make sure that we look good with all 3. And the thing is that all these 3 bureaus, they actually work independently from each other. They put the system in place so that there's not just one bureau that has a monopoly, right, on credit. So it is built there to some degree so that the information could benefit, right? If you're checking 3 places instead of just one, it's supposed to be built for the consumer, but it's not always the case. And I'll dive into that in a little bit. But what they're doing then is assessing your score. And your credit number score is made up of 5 different factors, right? So the 5 factors are like this. Number 1, most important thing that contributes the most to your credit score is payment history. So they're going to say, okay, based on your credit card or your auto loan or your mortgage, do you have late payments on your report? So they're looking at, okay, do you have a 30-day late payment? Were you late 60 days? How many times were you late 60 days? So they're accounting for that. Do you have collections? So a collection is what happens when, you don't pay a credit card for some time. They end up charging off that account, and the bank sells it to a collection company. And now the collection company is trying to receive that money back and collect on the debt. So they're checking for collections, medical collections, judgments. So that's the biggest part is, okay, do you make payments on time? They need to know that.
Right.
That's 35% of your score. Now, the second factor that they look at is account usage. Now, what that means is, let's say I've extended you credit. I give you a credit card with a limit of $1,000. Out of that $1,000, how much of that credit are you using? Now, if you're using $999 out of that $1,000, it looks like you're high risk because the bank has given it to you, but you're using all of it. And they wonder, why are they using all of that? Are they in debt? Do they need more credit? So you actually start seeing decreases in your credit score if you're using too much credit.
Got it.
So that's a big part of your credit score, right? Is account usage. The next thing they're looking at also is age of credit. So if you're someone who's completely new to this country, and let's say you've only been able to build your credit for 1 year, you can have a 700 credit score because you're making payments on time. But compared to, Mr. Smith, who has a 700 score, but has had credit for 25 years, that number score is not always equal.
Correct.
Right? So they're going to look at the average age of credit. That's very important. And then the other factor that they look at is mix of credit. So they want to actually see that you have different types of credit. So it's not always bad for you to have student loans or to have an auto loan, because the bank is seeing, okay, if you can manage these different types of credit and make payments on time, I can actually trust you.
Got it.
Right? So it seems a little counterintuitive, but if someone has been able to manage a student loan, if someone's been able to manage their auto loan over 5 years versus someone who only has one credit card, right? They're trying to say, well, actually the person who's borrowed but been able to manage is financially very strong, to the sense of being able to extend credit because they're able to make payments on time.
Right,
They've
right.
shown that. And then the last thing is new credit is what they look at. So when the bank runs your credit, it's what's called a hard inquiry. I'm sure you might have heard of that term, right?
Yes, yes.
So if a client has a lot of inquiries, that also shows the bank, this person is continuing to apply for something. Is it because they're in debt? Do they need something? It is a high risk. So you'll see these days when you get a response back from the creditor, it says too many inquiries or too many applications in the last 6 months, right? So sometimes when you go and apply for a car, I've had this happen to a lot of my clients. They get so excited. They're at a 750 credit score. They go to a random dealership and they say, I want to apply for this car. They say, great, let me see what bank wants to work with you. And it's like they just run it until the bank gives a good offer. So sometimes clients will come back to me. I pulled up their new report. It says 20 new inquiries on the credit report.
Wow.
Right? And they don't know. They just think, oh, the bank said, the dealership said they were finding me a bank. I thought, I was just going to run one inquiry. But no, it turns out they ran 20 new inquiries.
Wow.
So that actually impacts your credit score because they think now you're high risk because you've been trying to run your credit with so many different banks.
Wow.
So those are the 5 factors they're looking at. It's a lot. There are a lot more dimensions to it than just payment history. So those are some of the things that you want to keep in mind as you're coaching people and telling them how to work on improving their score.
This is awesome. This is so much information. Thank you very much.
Yeah.
Samantha, what would be your piece of advice for younger generation when they first starting to open up their new credit card? Let's say, at what age do you recommend a parent should allow a child or add them on to their credit or to open up an individual account for a child? Let's dive right into that.
Okay. So in America, you have to be 18 years old to establish credit in your own name. So for me, when I went to college, I signed up for like a Bank of America college rewards card, and I was able to get approved. I think my first credit card was $500. Not a lot, but I was able to build that out over time. So that is the youngest you're able to do that. But I do see a lot of people where they are older, they're in their mid-20s or even in their 30s, the first time they ever apply for any credit card.
Wow.
And that's waiting too long. You might as well start as young as you can so you start that age of history and you're able to extend on that. But if you had a parent who wanted to help you, and let's say they have established credit of their own and they say, hey, I want to help my child establish credit, depending on the bank, you can actually start as young as 13 years old. So for example, let's say your parent has an American Express card, right? So my mom actually did this for me. She added me to some of her credit cards to help me establish my credit, where she added me as an authorized user. So it's not a joint account. Those are 2 different things. It's where the existing credit limit, the existing credit card, you're able to add someone as an authorized user, and the history of that card actually helps the new individual build up their own history. So some of these banks, you're able to do it when your child is as young as 13, 14,
Interesting.
15. And so they actually get a head start on the people who establish it when they're 18 and they're able to. So that is something to think about if you have a young child and you have great credit of your own. So you can give them a leg up and help them start their history a little bit before.
The only thing is to look out for is to make sure the child will not get too excited and start overspending, right? And then the parent is responsible for the bill.
Yeah, no. What I've seen before is people will add their child, but they'll take the card and they'll keep it. So the child will have no access to that credit history whatsoever. It's just really a means of helping them build up their profile.
Wow.
and their history.
This is very interesting.
Yeah.
Let's talk a little bit more about debit versus credit.
Okay. Yeah, so there is a difference between what accounts show up on the personal credit and what doesn't. So for example, debit card payment history, that is not at all going to show up on your personal credit report because the money that's in your checking account is money that you put in. It has nothing to do with a bank deciding to lend you anything. Right? So if you have, let's say, a phone bill or a cable bill, you make those payments on time, that's not necessarily going to show up on your credit report. Now, these days, there are programs that credit bureaus have put in place where they can start reporting that, but it's like a specialty program. So, for example, Experian, they have something called Experian Boost, where they can connect the credit bureau with your checking account and start reporting some of this positive history. They do have that option, but it's not something where it's automatic where your, debit card purchases will show up on credit. They're separate. Now, the thing about those types of programs, for me personally, I don't always love an Experian Boost, and I'll give an example. Why? I see a lot of times when I look at credit reports, you'll see on Experian, okay, they have a utility bill that they're paying and it's $34 a month, right? So they'll show that payment history. But if the client already has established credit, they already have credit cards, $5,000 limit, $10,000 limit, they have auto loans, that $34 payment that you're making does not help the client in building their credit history. And it might, in some cases, actually shorten the average age of credit. Because if that history just automatically starts reporting, it might impact the credit they've already established over time. So I do think it's always good to speak to someone who maybe is a little bit more well-versed in reading the credit profile and ask them, should I do this or should I not do this? And have that conversation. But yeah, typically, those types of debit accounts are not going to show up. It has to be credit that is extended to the borrower.
Interesting. So debit card versus credit card, it's two different directions.
Yes.
Have nothing to do on the same scale. And you and I joked around. We said, wow, I just kind of hit me out of nowhere that a lot of people that I know using their credit card very wisely.
Yeah.
I see them traveling the world.
Yes.
How do people do that? Let's talk about that.
Yeah, I mean, the benefit of having credit cards is that there are so many banks out there that actually have strong rewards programs.
Like American Express.
American Express has it, Discover. There are different tiers that you get with credit cards, right? So if you have a top tier relationship with one of these banks, they have sign-on bonuses. So for example, I think with Amex, if you sign on and you spend, let's say, $5,000 within 3 months on one of the cards, they'll extend you $100,000 rewards points. And the equivalent is around $1,000.
Wow.
That you can spend now on purchasing a flight, anything like that. So if I have my clients and I'm coaching them, I actually tell them not to be scared about building credit or applying for credit. A lot of times because of, again, money association, they equate credit to having debt and they get scared. But credit, really, it's a tool. It's a tool for you to be able to not only, borrow things at a lower interest rate, and we'll talk about that, but it does give you the ability to get these amazing rewards points and all of that. So I tell my clients, do not overextend yourself. You're going to put all of the debit purchases you would typically make on your debit card, put it on your credit card instead, set up automatic payments, use it responsibly. But if you're going to be spending that money anyway, you might as well get some kind of benefit.
Absolutely.
Right? So even for me, I have a Delta Amex card, right? So one of these cards that I have, if I am looking to purchase a flight with Delta, and I want to shop with miles because, again, now I've built out my cards, I have extra miles, I book my ticket, and I'll give an example. I was booking a ticket to Seattle, round trip for next month. Usually it's going to be maybe $650 if I have like a dollar cost to it. But I booked it with points and then I checked out with my Delta Amex card. They give an additional 15% discount on the ticket price. So I think my flight ended up being $480.
Wow.
Yeah.
And it's all because you're using your credit very carefully.
Yes.
You're paying it off on time.
Yep.
And you are just being smart individual that had a wonderful mother who began this process and guide you in the right direction.
Yeah.
Well, let's talk a little bit more about minimum payments, because I know that each credit card has minimum payments versus full payments.
Yes. Sure.
Instead of people that may be in financial problems and they just lost their job, or they can't afford to make the payments in full, or they have other life events that's taking place. So minimum payments versus no payments.
Yeah, making a minimum payment is going to be very important, again, for the payment history factor that goes into credit. So if you're coming into a season where maybe you think you might lose your job or you're going to be moving, the worst thing you can do in that moment is miss a payment. And the reason why is once you lose a payment and miss a payment, it is going to stop your ability to find a way out. Right? Sometimes when you're in this situation, you might actually need to get a short-term loan, or you might have to, give up your car payment, or you might have to apply for a new apartment if you move. So once you miss a payment, your credit score immediately is going to drop. I've seen some cases where it drops 50 to 100 points if a client doesn't have a very strong profile. And so setting yourself up where you're making at least the minimum payment is going to be the best thing that you can do for yourself. So if you can't make your payments in full every month, I understand there are going to be some months where things get difficult, but try the absolute best at least to continue making the minimum payments so that your credit score stays strong enough for us to figure out a solution and make some moves. But yeah, if you miss a payment, it gets really tricky. It's not the end of the world, but once you start that cycle of missing a lot of payments, it is going to be harder for you to find a way out.
Samantha, I think I recently remember we had a case where the buyer was applying for a co-op, right? And I called you.
Yes.
And I said to you, Samantha, I think they missed 3 times
Yes.
on their credit card payments. Well, you and I very quickly know this is like a symptom we'll identify immediately.
Yes.
That it will be a no-no for a co-op board, because
Correct.
the minute you show a co-op board that you missed 3 credit card payments, we already know this is no chance for this buyer to get approved.
Yeah.
But you could step in and find ways of how you could maneuver that situation with credit bureaus and fix this type of issues. Let's talk about that.
Well, it really depends, right? The credit bureaus, they're just reporting what information they get with the actual creditor. Now, let's say the creditor reports you as missing a payment, but you actually didn't miss a payment. That actually happens a lot more often than you think. Now, that is a mistake, right? That's misreporting. It's an error that's on the credit report. That is definitely something that we can get fixed up on the credit file. There are methods in being able to do that. Now, in your client situation, the difficulty with that was that the payments were actually very recent. So having a recent late payment and applying for a co-op is different from having a late payment 5 years ago.
Got it.
Right? So the late payments 5 years ago too, it might be sometimes a bit easier to rectify that situation versus something that is very recent, something where an account is still open. But there are times where we've been able to actually reason with the creditor. We call them directly and they'll say, okay, in good faith that this person will be a good borrower, we'll remove that late payment off of the credit report and put them back in good standing. It happens. It's not a guarantee though, because again, if the client is actually late, they're late. There are going to be a lot of repair companies out there that say, oh, I'll send some work out, I'll send disputes and we'll get it removed. That's not always the case. Sometimes it is a little propaganda, right? There are actual, fair, real methods in being able to get items corrected on the report if there are mistakes. But yeah, in that client's situation, we might have to do other things to tackle an increase in scores. Right? There are other factors that we could look into to help improve the overall profile. But yes, every situation is going to depend on how late the client is reporting and how recent that late payment is on the report.
Boards are looking at DTI,
Yes.
debt to income ratio. Standard formula is to be under 30% category. So under 30%, that's what you're allowed to spend. Everything else, the banks and all the credit repair agencies are looking differently. So let's touch that.
Ratio is calculated by how much income somebody is bringing in, and then how many payments or how much they have in payments on their credit report. So let's say I have a client who's looking to purchase a home. I literally just walked through one of my clients yesterday. He says, hey, I want to work on my credit because I want to buy a home and this is my budget to buy a house. I want to get something for $600,000. So I start looking at his credit report and I say, okay, Ken, you actually have an auto loan at $1,000 a month that you're paying, right? And your interest rate, I did the math, was very high. It was about 24% for him. Wow. And I said, okay, if we work on improving your credit and we get your score to a 700, we could refinance the same auto loan and you can drop your payment by $400 to $500 a month.
Wow.
Right? Because if we get him a rate in the single digits, that is actually what the difference would be.
Right.
Now, the bank, when they're looking to extend a mortgage to you, they're going to be looking at the total monthly payments the client already has, and can they afford to get a mortgage? Now, what we do a lot of is strategizing, because for this particular client and a lot of borrowers that we work with, they don't realize every $500 monthly expense on the credit report might be a difference of qualifying for close to $100,000 on a mortgage.
Correct.
They don't know that. So I said, okay, if you really want to get a house and you really want to qualify for something that's a $600,000 purchase price, it's not going to work right now. But if you can reduce the monthly debt that you already have and drop it by $500 a month, you might actually end up qualifying, going from $500,000 to $600,000.
Right.
So yes, your total monthly payments, whether it's auto loans, student loans, credit cards, existing mortgages, they're going to add all of that up and say, based on this person's income and how much they bring in, their total monthly payments they already have, way too high.
So high risk.
Very high risk, where it's just not going to work, because the bank, they have their own qualifications, they have their own percentages, and they say, if our limit is going to be 30% or our limit's going to be 40%, there is no way around it, right? We can't exceed that number. So it is something that we have to teach our clients about, educate them on.
Money management.
Money management. I mean, we talked about this the other day, Olga, right? You had a client who was about to close on a deal and they ended up co-signing for somebody else on an auto loan.
Yes.
Now, all of a sudden, you have a new, how much was the payment? Maybe $700?
Yes.
Shows up on the borrower's credit report. The numbers don't work now for the debt-to-income ratio. That's it. So, yes, it's a lot of strategic planning.
I joke about it all the time, and buyers sometimes, I would say I'm very blessed to work with very serious and responsible buyers.
Yes.
And I pick and choose when they are ready, willing, and able to really take this serious.
Yes.
A lot of times they reach out and we tell them, look, you are in great position mentally, emotionally, but you financially not there yet.
Yeah.
And it's the last thing I want is to put anybody in their mortgage payments that they can't afford.
Correct.
I don't believe in becoming a slave to your walls.
Yes.
I believe that you need to enjoy where you are and you need to be ready, willing, and able.
Yes.
This is what I'm training my clients. And so when it comes to really borrowing the money, I pick and choose those that are ready and willing to be in that momentum.
Yes.
And really be in the next chapter of journey financially, where they're managing their money properly.
Yes.
And if they are not, they're not there yet.
Correct.
So this is where I come in, right?
Yeah.
I don't think I rate myself only as an agent, as a broker, or somebody who helps people find a home or sell a home. I really look very carefully in their financial behaviors. And this is why it was very crucial for me to bring you on board, so you and I collectively together can educate the consumer to understand what does it take to become financially responsible.
Yeah.
And if you're not there yet, it's okay.
Yes.
Sometimes it takes time to be there. Some kids just born with DNA being responsible with money. Like I have one of my sons who is extremely responsible.
Yeah.
And he's just really, really on the point where he is just like watching every dollar.
Yeah.
And I'm so proud of him because he's really getting into the right direction when it comes to money management. Yeah. And some that just need a little bit more time to work on it, and that's okay.
Yes.
Everyone needs to take their time. But Samantha, let's talk about free credit and how one can pull one for free. Because if a person runs a credit, let's say at least once a year.
Mhm.
And now credits are given for free on Chase apps.
Yeah.
Like if you
sure.
have a Chase account, like I open up my Chase account
Yes.
and I see my credit all the time.
Yeah.
So let's give them a website where people can get a free credit.
Yeah, that's a good question. So yes, you are able to see an overview or see some of these reports online through Chase. It's Credit Journey. But even for that one, that is only through TransUnion. So you're not able to see what's on Experian or what's on Equifax. So what I do tell my clients to do is if you want a completely free report and you want to see all of the accounts, all of the payment history, you can go to annualcreditreport.com. They will give you a free report and it contains all of the information. It's not limited in any way from each of the credit bureaus, but the only thing with that website is that they won't give you an actual number score. It's really just going to go over the detail of the account. It's still good to get that report just so you can double check, make sure the payment history is correct and there are no collections, anything like that. If you do want to get a report that has an actual score, there are websites that give you credit monitoring options and you're able to sign up and get it. A lot of my clients use the service. It's called Identity IQ. So you can pull a report there. It's maybe $19 to get the full report, but they will issue you a score as well. So sometimes people want to be able to know where they're at numerically as well. But I will say, the credit system is a little bit complicated sometimes. There are different websites to go on. People use Credit Karma all the time. Even Identity IQ, it's a Vantage score. And the Vantage score is different from a FICO score, right? So the FICO score, if you're looking to apply for actual credit cards, the banks are typically checking there. So they do have another website. It's called myfico.com that you can use to get an actual FICO report. It's $35, but if you want to get that one that seems to be more accurate or in line with what the lenders are looking at, there are options there as well.
We had so much information covered in this episode, and there is so much more coming. So we're going to talk about bankruptcies. We're going to talk about student loans. We're going to talk about businesses versus personal loans. So everyone stay tuned. If you have any questions, please reach out to Samantha. She is with Credit Repair Boss Company. Samantha, please tell everyone your contact number and how easy it is to find you.
Oh, sure. So you can go to our website. It's creditrepairboss.com. If you look us up on Google, we have a lot of reviews there as well. So you could read up on that. And my direct number is 917-536-2800. So you could reach out to me there as well.
Beautiful. Excellent. Thank you, Samantha. It was a pleasure.
Thank you.